The Big Short. Who is Michael Burry? Michael Burry is not your average investor. In fact, he's one of the most intriguing figures in the financial world today. He's a doctor turned hedge fund manager, a rare transition that speaks volumes about his unique skill set and determination. Burry is famous for predicting the 2008 housing crash, a feat that not only saved his investors, but also made him a legend in the financial community. He made a fortune betting against the market when everyone else was riding the wave of the housing boom. His contrarian bet paid off massively. His story was so compelling that it inspired the book and movie The Big Short, bringing his incredible journey to a wider audience. Burry is known for his intense research and contrarian bets. He spends countless hours poring over financial statements and data. He digs deep into financial statements, looking for hidden truths that others might overlook. He doesn't follow the crowd. Instead, he trusts his own analysis and instincts, even when they go against conventional wisdom. This approach has led to incredible successes and some notable misses, but Burry is not afraid to take risks if he believes in his research. When Burry makes a move, people notice. His decisions are closely watched by investors and analysts alike. His recent actions have sent shockwaves through Wall Street. His moves often spark debates and discussions among financial experts. He has been selling off significant portions of his U.S. stock holdings, a move that has caught the attention of many. This has many wondering, what does Burry know that we don't? His actions suggest he sees something on the horizon that others might be missing. Whether he's right or wrong, one thing is certain. Michael Burry is a financial force to be reckoned with, and his moves will continue to be scrutinized by those looking to understand the markets better. Burry dumps stocks, a $70 million warning. Recent filings reveal Burry's Scion Asset Management has been trimming its positions. This isn't just a minor adjustment, it's a significant move that has caught the attention of many in the financial world. The filings show a clear strategy of reducing exposure to certain sectors. In the last quarter, the fund sold over $70 million worth of U.S. equities. This massive sell-off is not something that happens every day and has led to a lot of speculation about Burry's future market outlook. This follows a pattern of selling that began earlier in 2024. Analysts have been closely watching Burry's moves, trying to decipher what this could mean for the market in the coming months. Among the stocks Burry sold are some well-known names. These include major tech giants and consumer brands that have been staples in many investment portfolios. He significantly reduced his holdings in tech and consumer discretionary companies. This move is particularly noteworthy given the recent performance of these sectors, which have been under pressure. This indicates a lack of confidence in these sectors. Burry's decision to pull back from these investments suggests he sees potential risks that others might be overlooking. Some might dismiss this as just another investor adjusting their portfolio. However, the scale and timing of Burry's actions make it hard to ignore. But Burry's history of accurate predictions makes this different. Known for his foresight during the 2008 financial crisis, his moves are often seen as a signal of underlying market conditions. His moves are often seen as a barometer for the broader market. Investors and analysts alike will be watching closely to see what Burry does next, as his actions could provide valuable insights into future market trends. Why is Burry selling? Decoding the bearish signals. Michael Burry, the famed investor known for predicting the 2008 financial crisis, has recently been selling off significant portions of his portfolio. This has left many investors and market watchers wondering, why is Burry selling now? While Burry hasn't publicly stated his reasons for selling, we can speculate based on his past comments, current market conditions, and broader economic indicators. Burry is known for his deep analysis and often contrarian views, so his actions are always worth examining closely. One possibility is his concern about rising inflation and interest rates. Inflation has been a growing issue, with prices for goods and services increasing at a rate not seen in decades. The Federal Reserve has been raising interest rates in an attempt to control this inflation, but these actions come with their own set of risks. The Federal Reserve's rate hikes are designed to cool down the economy and bring inflation under control. However, higher interest rates can also slow economic growth, making borrowing more expensive for both consumers and businesses. This delicate balancing act can lead to economic uncertainty. The fear is that these measures could tip the economy into a recession. Economic slowdowns often lead to lower corporate earnings, higher unemployment, and reduced consumer spending, all of which can negatively impact the stock market. Another concern for Burry might be the current high valuations in the stock market. Many stocks are trading at prices that seem disconnected from their underlying fundamentals. High valuations can be a red flag, indicating that the market is overheated and due for a correction. Some experts believe that the stock market is in a bubble, driven by speculative investments and excessive risk-taking. When bubbles burst, they can lead to sharp declines in stock prices, causing significant losses for investors. High price-to-earnings ratios suggest that investors are paying a premium for stocks, expecting future growth that may not materialize. This disconnect between stock prices and company earnings can be a warning sign of potential trouble ahead. Given these factors, Burry may be taking profits now to avoid potential losses later. By selling high, he can lock in gains and reduce his exposure to a market correction. Finally, geopolitical uncertainty and market volatility are likely influencing Burry's decision. The world is facing numerous geopolitical challenges, from the war in Europe to rising tensions in Asia and political instability in various regions. These geopolitical risks create a lot of unknowns that can impact global markets. The war in Europe, for instance, has led to energy supply disruptions and increased defense spending, while tensions in Asia could affect trade and economic stability. In such an uncertain environment, Burry might be reducing his exposure to risk. By selling off some of his holdings, he can better position himself to navigate the potential challenges and opportunities that lie ahead. Should you follow Burry? Lessons for everyday investors. Burry's moves are closely watched, but that doesn't mean you should blindly follow them. His investment style is very high risk, high reward. It's not suitable for everyone. What you can learn from Burry is the importance of diversification. Don't put all your eggs in one basket. Spread your investments across different asset classes. Staying informed. Do your research. Understand the companies and sectors you invest in. Having a plan. Don't make emotional decisions. Stick to your investment strategy through ups and downs. Remember, investing is a marathon, not a sprint. It's about long-term growth, not short-term gains. Section 5. Burry's Big Wins and Losses, A History of Hits and Misses. Burry's track record is impressive, but it's not flawless. He's made some incredible calls, like predicting the housing bubble. This earned him and his investors billions. However, he's also had his share of misses. Some of his recent bets against Tesla and Cathie Wood's ARK Invest haven't panned out. This highlights an important point. Even the best investors make mistakes. No one gets it right all the time. It's about managing risk and learning from both wins and losses. Section 6. The market's mood, uncertainty, and volatility reign. The current market environment is characterized by uncertainty and volatility. Inflation remains high and interest rates are rising. The war in Ukraine continues and geopolitical tensions are simmering. This uncertainty is reflected in market swings. We've seen periods of sharp decline followed by brief rallies. This can be unnerving for investors, especially those new to the game. It's essential to remember that markets are cyclical. There will be ups and downs. Don't panic sell based on short-term fluctuations. Focus on your long-term goals. Section 7. Playing it safe. Diversification is key. One of the best ways to navigate market uncertainty is through diversification. This means spreading your investments across different asset classes. Don't just invest in stocks. Consider bonds, real estate, commodities, and other assets. This helps reduce your overall risk. If one asset class performs poorly, others can cushion the blow. Diversification is like an insurance policy for your portfolio. It won't prevent losses, but it can help you weather market storms. Section 8. Stay informed, stay ahead. The importance of research. In today's fast-paced market, staying informed is crucial. Don't rely on rumors or hearsay. Do your research and understand the companies you invest in. Read financial statements, analyze industry trends, and follow market news. There are many resources available to help you, from financial websites to investment books. The more you know, the better equipped you'll be to make informed investment decisions. Knowledge is power, especially when it comes to your money. Section 9. The bottom line. Burry's moves matter, but so does your plan. Michael Burry's recent stock sales have grabbed headlines, and for good reason. His track record demands attention. However, it's essential to remember that his investment style is not for everyone. Instead of trying to copy Burry, focus on what you can control, your own investment plan. Diversify your portfolio, stay informed, and stick to your strategy. Remember, investing is a personal journey. What works for Michael Burry might not work for you. Find your own path and invest in a way that aligns with your goals and risk tolerance.